Good afternoon. Peter Klein, Chief Investment Officer, co-founder, Align Wealth. This is a little bit of a redo, if you will, an addition to a previously done video that we did about the debt levels that we're seeing in the United States and frankly around the world, and how those do have us somewhat concerned. So allow me to share my screen and we'll walk you through a quick briefing. So in this first slide, you'll see the government debt number, right? We have it here as $30 trillion, and it's going up. And as you can see, this is higher than typical, right? In the past, we've seen, these levels over here. The change, as you can see from COVID, dramatic, and that is what we've talked about with respect to our inflation call. I urge you to look at our website to see some of our other videos that speak to this inflation call, but this we believe was a spark to it. Proceeding though, this is the amount of U.S. government debt, and as you'll see in a moment, this is just the United States government debt, $30 trillion. If you add in unfunded pension liability, Social Security, Medicare, Medicaid, as well as municipal debt, corporate debt, personal, you'll see a larger number in a moment. This is what we're focused on today, is U.S. national debt, government debt. And as you can see in this particular slide, it's pretty substantial amount versus the government, the GDP. The way I want you to look at this is that if GDP is your income, right, your household income, the amount of government debt that we have is the amount that you owe, versus, relative to that income. Okay, so 123%. And that's the highest except for right after COVID, right during COVID. This is the government, the U.S. debt clock. If you want to get yourself sick, usdebtclock.org. And in here you'll see all the different machinations. Here's that $30 trillion of debt is somewhere in here. It's hard for me to read, but you'll see it all here. And you'll not just see the government debt, but you'll see the municipal debt, corporate debt, and all the different pieces of the puzzle. And it is not the greatest puzzle. I guess here's your 30 trillion right here, U.S. national debt. Okay, so what we wanted to do as a teaching lesson, as a sort of thought experiment, was to look at the 1980 setup. Remember, we have this call that says, 40 years from 82 to 22, that regime of lower interest rates, lower inflation is behind us, and we're in a new era, a new regime today. And part of that interfaces with the debt level issue. So what I wanted to do is compare the statistics that we see here of the United States economy in 80 versus 22. And as you can see, we've seen a substantial 10x increase in the GDP, even dramatic increase in the deficit and the debt outstanding, as you can see here. But what I want to clue in on, what I want to focus on, is in 1980 we had issues, but we didn't have the amount of debt that we have today. 36% of the federal debt, 874 billion, to GDP. 36%. Remember the last slide? 123%. It's 3-4 times the amount. So that's a big deal. And so this is where I get, sort of concerned. And this is the other number. This is that total debt number, and that's 370% of GDP. So this is the pre-2019, before COVID chart, and what this is looking at is you have your tax revenues is I guess that's this line here, and then you have the expenses, including net interest expense, and that's what I want to focus in on, that net interest expense. And as you'll see, this was actual, this is projections, CBD, the Congressional Budget Office, CBO. And what we want to look at is the ballooning of the net interest expense. I mean, defense is going to be what, I would argue defense budget would probably go up in this world of ours, right? It's certainly been a geopolitical, year. So I don't think that's just sort of calming down overnight. Let's hope, but hope is not an investment strategy. So that's spending there, and then you've got of course, non-defense discretionary spending. But the net interest expense is the one piece that it will go up due to no interest rates, right? I mean, and so let's just see what that impact is and move along. As the rate goes up, so does the debt service. I mean, you could say, what else do you want to tell me, Captain Obvious? But what I want to show here is here's the five-year Treasury. Here's the debt service. What do you think is going to happen to debt service when if the Treasury's up here? This is going to start going up, and that's that interest expense that we saw before. And here again is another sort of analysis is showing how much of the bonds that's currently outstanding debt of the U.S. government and where their interest rates are, and it's pretty telling that you have certain debt service ratios of the greatest one is the greatest amount. And this is the inflow. This is the money that's coming into the government. Yeah, I guess that we'll see an increase in tax rates, and so we'll probably see this go higher. But how much higher really compared to the outflow? This is just one of the outflow. That's the defense budget. But in this slide, we see a bunch of different outflows from Medicare expenses, healthcare, Social Security, income security, and other education, of course. The point is that federal spending is for 22 to 20. This is for 21. 22 is even probably higher. It's not. It's much more than the revenues. Therein lies the deficit issue. But again, that's spending. It's the interest expense that I want to clue in on. In the interest expense, that's this piece. And as you can see, this is now 2022. As you can see, this even ballooned a bit more. I figure I'm looking out to these latter year projections. You can see it's about maybe $1 trillion of net interest expense. And we're getting that right. Yeah. Increase, from, and so what happens to that interest expense when interest rates go up? That was the thought experiment we sort of worked on. So what we did was we looked at 1980 as an example compared to now. And what we did is we looked at what the current interest rates are very low. We know that they've gone up obviously this year, and so if you expect a 300 basis points, folks, we're halfway there already. A couple more 75 beat moves and we're there. If you assume a 300 basis point increase in interest rates, interest expense will increase substantially to $6 trillion. This is a trillion. So this is saying it's going to go up 6x to what the CBO expectations are if interest rates go higher. That's because we have so much debt at such a low interest rate that once that interest rate goes up, as it has, that's going to cause a big shock to the system, so to speak. And that's why we've seen, this is from our friends at Malden, we've been seeing things like this that says, hey, in the out years 30, 31, 32, look at a sizable increase in debt, look at a sizable increase in the deficit. Something's got to give. And what would that be? They're going to cut defense spending? They're going to cut Medicare? I don't think so. So this is why we are concerned, and why we think that being cautious in here makes a good deal of sense. Thank you for your attention. Appreciate your time. By all means, reach out to us at Align Wealth for any of your questions, comments, concerns. on this particular video or others we have done. We're happy to chat with you, review your investment policy statement, as well as your financial plan and wealth management plan. And we're here to do so. And so, by all means, give us a call. We're happy to discuss your portfolio and review what you're planning procedures as well. Thank you very much. Have a great weekend.